Hey, what's going on everyone? It's Griffin here. So I made this video a couple of months back speaking about whether or not a first-time homebuyer should be either looking to save or invest towards the purchase of that first property, depending on your own personal circumstances. This is a topic that I get asked all the time considering the current economy, low interest rates, high stock market valuations, and just the overall current state of the real estate market across North America, but specifically here in Canada. So definitely make sure to check that video out if you're a first-time homebuyer looking to acquire that first property and you're questioning what the best method would be for your circumstances to build up towards that down payment. Now, this probably isn't new information to most of you watching, but over the course of the pandemic, property prices across the board, including single family homes, condos, as well as townhomes, all shot up in value dramatically, mostly as a result of cheap mortgage debt through low interest rates, as well as a lack of supply and inventory in the market and strong immigration figures, period, and even more so towards metropolitan areas. Since early 2020, average home prices across the nation have in some markets even doubled in value, making the dream of home ownership quite bleak for many groups of people, especially first-time homebuyers as well as millennials. What's ironic though is that in September of 2020, so almost a year ago at this point, a poll commissioned by Scotiabank indicated that respondents aged 18 to 34 were the most optimistic about buying a home in light of the pandemic. But even considering this optimism, 32% of millennials stated that they were waiting for house prices to actually drop in value before they make a move to pull the trigger and buy. Now, to be fair, considering the prices at the time having already shot up in value quite dramatically, well, this was and still very much is a logical assumption. However, since then, market prices across 26 different markets in the nation have shot up anywhere from another 5 to even 27% on average. Single-family homes in Ottawa have increased by 26%, in Toronto 14.6%, Vancouver 16.4%, London 35%, all of this year over year since 2020. I think we get the point that while many have been waiting for and anticipating a crash, the exact opposite has ended up materializing. This is a classic case of investors trying to time the market in the short term, thinking the market will react one way, where in reality, it ends up going the exact opposite manner, seemingly defying all logic. After all, any type of market that goes up in value by 50 to 100% in only a couple of years should most likely see a quite sharp correction, right? Well, this now begs the question more than ever, should you even consider purchasing a home in the current market environment or simply continue waiting? And is it even probable that we see market values for properties across Canada drop anytime soon? First off, I think it's important that we highlight some data about property transaction volume, expected growth through to 2022, as well as interest rates. Based on data provided by RE/MAX brokers and realtors across the nation, the Canadian housing market is actually expected to remain strong this fall through to the new year. Now, of course, it's in RE/MAX brokers' best interest to actually sell homes and generate commission, so definitely take that with a grain of salt. But interestingly, across Canada, there's expected to be more appreciation in property value by an average of 5%, even though transaction volume has been steadily declining. In fact, the month of August was the fourth month in a row posting negative growth figures for transaction volume across Canada, as the number of individuals looking to sell their homes has been seeing a large decline despite record high price levels. Do note though that despite declines in property transaction volume, it still remains significantly above average. Essentially, you can sell your property for an elevated price point, but you're faced with this exact same issue on the receiving end when you look to relocate, which I think has turned off a lot of potential sellers at this point. In fact, we can see this data firsthand for most primary markets across Canada. On an aggregate level, average sold prices have definitely declined from their peaks in March 2021, but have still managed to maintain steam relative to the total number of transactions, which has dropped off dramatically. And certain markets have retained significantly more value than others, notably Toronto, that has actually seen an increase in price despite lower transaction volume, and the same thing applies to Vancouver, Montreal, as well as Ottawa. Now, in other news, the Bank of Canada is actually predicting further economic growth of around 4.5% in 2022, which of course would help continue driving the economy and maintain housing prices, at least stabilizing them. So again, at this point, is it probable that we continue seeing home prices drop by another 20-30% in the short term? Of course, it goes without saying that it's almost impossible for pretty much anyone to accurately predict how a market will trend and react in the short term. However, I think this will ultimately come down to two main factors. First of all, to see a significant decrease in property prices across the board, the way I see it is that we need to see a very large increase in supply to the market, including foreclosures and increased interest rates, highly impacting what people could qualify for in the first place, as well as whether or not they'd be able to maintain their monthly mortgage payments at a higher interest rate. So let's break this down, starting with the inventory supply, which is pretty simple to grasp. All other factors being equal, when property supply drops, this typically results in increased price points for the asset in question. That's exactly why we've seen insane bidding wars over the past year and property prices ultimately skyrocketing in value. Combine that with cheap debt and, well, you get what we've just lived through. But unless we see a significant increase in foreclosures, which for the record, I doubt we're going to be seeing moving forward based on the data I could gather, well, I don't think we're going to see an increase in supply that's dramatic enough to really move the needle on a monumental price drop across the board for property prices in Canada. In fact, this table right here highlights the current amount of mortgages in foreclosure at the present moment. And we can see that the total number of mortgages across the country is at 0.18% of all current mortgages, which is extremely negligible at this point. In addition to this, the average equity in homes across Canada is 73% of the home's value. So leaving that on the table through a foreclosure would be almost unseen. And someone who's in a tough financial situation would be far better off just refinancing their home at a low interest rate right now, take out some of that equity and maintain their payments rather than selling the home in the first place or letting the bank repossess it. This now leads us to the topic of interest rates impacting home values. So with lower interest rates, this effectively means that you can pretty much purchase a larger home with the same amount of money because your monthly mortgage payments would remain the same. The cost of borrowing is a lot lower, so even if you pay more for a property, the monthly payment ends up being relatively the same. But again, based on what the Bank of Canada has most recently came out and stated about interest rates being increased in the near future, they're saying, first of all, that an interest rate hike will likely depend on economic recovery in the first place, and that we should most likely anticipate this no earlier than next fall. The reality here is that we're not facing the same type of situation that we were facing back in 2008, where pretty much everyone was being approved for multiple properties regardless of your credit score as well as your income. In my personal experience over the past 2 years, having purchased several physical properties, it's actually been very difficult to even get approved in the first place despite showing equity, liquidity, as well as cash flows. And the main reason for this is that since 2008, in order to avoid one of these catastrophic financial situations again, well, banks have been faced with significantly tighter regulations around who gets approved and for what. In fact, banks take their role as mortgage lenders extremely seriously and have to adhere to prudent standards for ensuring customers only take on manageable levels of debt. This is clearly evident when you take a look at the national mortgages in arrears numbers for Canada's 9 largest banks, which shows that less than 0.25% of homeowners have gone 3 consecutive months or longer without making a payment like we saw earlier. And in fact, this is also significantly less than in the United States. Also keep in mind that banks now take into account when they're doing their calculations for approval on a mortgage loan, whether or not the lender in question would be able to maintain their payments in the future on the loan if and when interest rates do end up increasing. This is what's known as a stress test, where banks will essentially take a look at whether or not the borrower can comfortably maintain their payments in the event of an interest rate increase. And finally, another telling point as to why I believe that we won't necessarily see massive decreases in value over the next couple of months, as well as an increase in amount of foreclosures, is because the largest holders of Canadian mortgage debt, being the large banks, have actually started decreasing significantly over the past year their after provisions for credit losses. Provisions for credit losses are essentially funds that banks put aside to account for possible loan defaults in the future. And in the height of the pandemic, the banks were putting massive hundreds of millions of dollars aside each and every quarter to account for what might come in the future. Obviously, things didn't go as south as we had potentially anticipated. And so for this reason, over the past year and a half, these banks have been lowering the amount of money they've been putting aside to account for these potential loan defaults. And so if we consider the fact that these banks are the largest holders of Canadian mortgages, they have hundreds of analysts, market analysts, as well as economists working full-time analyzing what's to come in the future. And so if they don't think that they're going to be seeing any large amount of loan defaults, well, that's definitely a green flag. So this now brings us to the question of whether or not a first-time homebuyer should still consider purchasing that first property right now or continue waiting and maybe renting for the time being. As always, I think this comes down to your personal financial situation as well as your circumstances for your living expenses at the given moment. With that said, I think that pretty much 95% of the time, it will be more beneficial to purchase a property instead of renting it in the longer term. This is because property tends to appreciate at a more stable pace than other asset classes, and on top of that, it forces you to build up equity in the property over time through paying down your loan. The only thing I would say is to not let emotions come into play when you are in the process of buying your first home, where you're severely overpaying at an amount that seriously makes no sense, even considering the current market environment. Because the second that the market would potentially go south, well, you are left holding the bag on a property that's market value is less than the value of the mortgage that you have out in that property. The reality is that for the average person, your home is most likely going to be one of your best ever investments in the larger picture, even though on paper, a home isn't necessarily an asset, as a liability is something that takes money out of your pocket each month. But I would argue with that because with a property, a home, you're paying down your loan. First of all, you're building equity, and then also the property is appreciating over time, where you're building equity, and this gives you a lot more leeway and leverage later on, where you can tap into that equity for other investment purposes. What's certain though is that renting forever guarantees that hundreds of thousands of dollars over the course of your life will be flowing out of your wealth, which could be contributing to your wealth, and will be flowing into the pockets and wealth of your landlord. In addition to this, in Canada, home equity accounts for an extremely large portion of the average household's total net worth. Again, mainly due to values steadily increasing over time, as well as debt being paid down and equity being built up in the property. Just take a look at this chart right here, showcasing household net worth as well as asset value, or home value, I should say, in relation to disposable income. So even though disposable income hasn't increased nearly as dramatically as home prices, well, home prices are contributing greatly to the increases in average household net worth. Let's take a quick look at an example between renting at an average market rent versus purchasing a home right now. So the average rent here in Ottawa for a 2-bedroom apartment is roughly $1,500 as of right now. If we project this over 10 years at an annual increase of 3% per year on that rent, this means that on rent alone, you will have given up over $200,000 to the landlord that you will never see again. On the flip side, if you were to purchase a home right now, even though it's at a somewhat inflated value, let's say you purchased a home for $600,000 at 5% down, meaning you would put $25,000 down in the property. Well, considering no appreciation on the building at all, which realistically would not happen, you're still going to end the decade with having paid down roughly $160,000 on the loan above your down payment, plus most likely at the very least a couple $100,000 in appreciation on the property over the next 10-year period. Now, of course, that was a very simplistic scenario in comparison, and I'm sure some people in the comments are going to say that there's added running costs in a house. Of course there are, right? For example, insurance on the house, as well as property taxes. You need to do a new roof. You're looking at $6,000, $7,000, $8,000. There are, of course, additional costs on a home. However, in the big picture, and pretty much however I slice it in all my different calculations and scenarios, you're pretty much going to come out ahead purchasing a the home rather than renting indefinitely. In addition to this, having equity tied into your assets is also a huge tool for leverage later on in life if you're looking to take some of that money or that equity and use for other investment purposes, as well as being approved for certain loans. So yeah, I always pretty much think that it makes more fiscal sense to purchase a house if you're able to and your circumstances account for purchasing a home over renting indefinitely. So to end this video off, of course, it makes logical sense to think that you're going to wait out and try to time the market for prices to decrease in value. However, as we've seen from the data, I personally don't think we're going to see house prices decline significantly in value, at least over the next year. So if you're still interested in purchasing that first property though, what I would suggest is trying to purchase a fixer-upper property. This is something I've spoken about numerous times on my channel, where you're buying a place that is either a bit below market value or right now maybe market value, not overbidding though, and putting a little bit of money into it, maybe through a rental loan, and yourself increasing the market value so that you can build some additional equity on the spot in that property. If you're interested in learning more about real estate investing, make sure to check out all the videos in my real estate investing playlist on my channel. So with that said, thanks a lot for watching today's video. I hope you enjoyed it. If you did, make sure to smash the like button and let me know down in the comments whether or not you believe that the data that we just looked over does warrant me believing that the market is not going to decline significantly in value over the next year. I'd love to know your thoughts on the matter. And yeah, if you want to learn more about stock market investing as well as real estate investing, subscribe to the channel and hit the bell button to be notified of new and upcoming content. So with all that said, I hope you'll have a great rest of your day, and I will see you in the next one.